What is interest receivable? Let's go back to accounts receivable so you can follow along on this. Now, if you're just an ordinary average Joe Schmo and you have a nice little yard and you hire somebody to mow that yard, what usually happens is when they finish mowing the yard, they'll come to you, they'll give you a nice little bill, and you'll just either hand them cash or maybe they have one of those mobile apps where you can swipe a credit card or whatever. Okay? And that's how you pay them. Well, major corporations don't work that way. What happens is when the lawn service, okay, whatever lawn service they have, mows the yard of a major manufacturer, what they do is they create an invoice. All right? And then the people who have mowed that yard hand that invoice to the major manufacturer, and that major manufacturer sends that invoice to the billing department. All right. And what happens is that the people that mow the yard will say this, okay, if you pay the bill, because we're giving you 30 days to pay us, or maybe they're really nice and they'll give you 60 days to pay them. Whatever it is, whether it's 30 days or 60 days or 90 days, doesn't matter. When the lawnmower people hand you that invoice, they say, okay, if you pay this before the time is up, we will take off, say, maybe 10 or 15% of the bill. Nice little discount for you. However, if you don't pay us before that time, when the bill comes due, you'll owe us the whole thing. So it will become a major priority for the major manufacturer to pay that bill before it's due. Okay? That way they can save some money. All right. Now, let's say that the lawn care service, they take care of the yard, they make this bill, they hand it to the major manufacturer then takes it over to shipping, not shipping, but billing. Now, just before the billing department actually pays the bill with a company check, company credit card, doesn't matter what they use. Now keep in mind that that little invoice for the services that were rendered by that lawn service has to be turned over to the IRS. And a lot of times it's turned over to the IRS to see if the major manufacturer can then therefore get a tax write-off. Okay. So just before the bill is actually paid, let's say a tsunami hits the major manufacturer, or a tornado hits the major manufacturer, or they're struck by lightning and the whole place goes ablaze. Well, here's what happens. At that point, of course, major manufacturers have insurance. But here's the problem. Insurance companies can take a long time to pay for the damages on your business. In the meantime, you still got to pay the bills. So that means you still got to put everything back together. That means you still got to get things started all over again. You can't wait for that insurance company to pay up because you still got to do business. So what they say is, okay, they go back to the people who mowed the yard. They say, look, I don't know whether you've read it in the papers or not. I don't know whether you watched it on TV. But we had a major disaster at our business. We simply cannot pay you right now what we owe you. So we're going to have you write us up a promissory note. And the people who have done all this lawn service for you say, hey, you know what? I did. I saw that on TV. It's awful. I am so sorry you're having to go through this. I know that the insurance company is going to reimburse you for all this, but I also know it's going to take up some time to do that. Because like I said, insurance companies don't just necessarily cut you out a check that same day. They have to do the investigation, the whole 9 yards. They say, look, we know the insurance money is going to come to you and you're going to pay us back. So here's what we're going to do. we're going to let you have some extra time to work this out with the insurance company. But for allowing you that opportunity, we're going to charge you an extra fee. And that fee is interest on the original bill. Okay. So this is where notes receivable becomes in play. Now this journal entry, this is a general journal entry. This would be done by the people who mowed the yard. Okay. So originally they had an accounts receivable. This 5,500 accounts receivable was the original note that the lawn service wrote to the major manufacturer, and they're waiting for the money. Now they have a promissory note. Notes receivable 5,500. Alright. Then they write down the terms of the note. It's a 60-day note. They're giving the lawn service is giving the major manufacturer 60 extra days to pay. But they're going to penalize them 15% for doing so. Alright. And then they say, well, the date that this whole note was created, okay, the date the note was created was on November 5th. Alright. 25 days pass. Now, as you know in accounting, you have to close out all revenue and expense accounts at the end of the month, so that all you're left with is the balance sheet. Okay, so now you have to create what is called an adjusting entry. November 30th. Interest receivable, interest income. Interest income is a revenue account. Alright, so this 5729, here's how it comes about. We divide 25 by 360. We take that number, multiply it by 5,500, and then we multiply the result by 0.15, which is your 15%. And that's how we come up with 5729. Now we're going to close out interest income by transferring this to a balance sheet account. Now what is a balance sheet account? It has to either be an asset, a liability, or owner's equity. Okay. In this case, it's going to be an asset account. The asset account is interest receivable. Why is it called interest receivable? Because we haven't actually physically received the 5729. We're just pretending that we did. We know eventually we're going to receive the 5729, but we haven't received it yet because the note is not due yet. Okay. It'd be really nice if all of a sudden the insurance company got their butt together and sent the money to the major manufacturer in a timely manner. Usually they don't. Okay. So we're going to pretend that this is the lawn service. The lawn service is going to pretend they have just received 5729 from the major manufacturer. They haven't yet, but they're going to. So we have interest income, which is a revenue account. We close it out and we transfer it to interest receivable. Now, what happens on December 1st? Well, we have to make what is called a reversing entry. So in the general journal, we're going to say that interest receivable is credited 5729 and interest income is debited 5729. And the thing is, we're going to have to go through the same process again on December 31st. Why is that? Because November 5th to December 31st is only 56 days, and this is a 60-day note. So the major manufacturer still has 4 more days after the 31st of December to pay up on this note. So what we do is we take 56 divided by 360, take that result, multiply it by 5,500, then we take that result, multiply it by 0.15, and then whatever total that is, and you can calculate it yourself, you can even leave a comment down below to show what that result would be. Then we would debit interest receivable for that amount and credit interest income. And by doing so, we're making an adjusting entry which closes out the interest income for the month of December. What do we do on January 1st? We reverse all that. By reversing it, we debit interest income and credit interest receivable. And then, of course, at the end of January, we're going to credit interest income, but at the end of January, we're going to debit cash. And that's how that works. All right. If you have any questions at all, leave a comment down here below. I will tell you more in a future video, so stay tuned.